Wealth isn't a mystery. It's a system you can build from scratch. In the next few minutes, I'll give you a practical, no-fluff plan you can start using today. This plan rests on 3 pillars: income, saving, and investing. Each pillar supports the next, and together they compound over time into real wealth. Get these in balance, and your money stops being a constant battle and starts being a growth engine. Step 1 is mindset and baseline. You have to know where you stand before you can change it. That starts with a true picture of your income, expenses, and debts. Track every dollar for 30 days so you see your patterns clearly. Use a simple notebook, a spreadsheet, or a budgeting app. The goal is to stop guessing. At the end, you'll be able to categorize your spending and identify waste. Set a baseline budget and commit to it. Choose a rule like 50-30-20 or 60-20-20, whichever fits your situation. Then apply it strictly for at least 2 full cycles to build discipline. Automate savings and build an emergency fund. Set automatic transfers of 10 to 20% of income into a savings account or money market fund. Aim for 3 to 6 months of essential expenses, so a rainstorm won't derail your plan. Increase your income where you can. Review your compensation strategy, gather proof of your impact, and ask for a raise or a promotion. Add a side hustle that leverages your skills and keep track of the extra cash monthly. Cut wasteful spending and optimize every dollar. Cancel unused memberships, compare bills, and negotiate utilities when possible. Even small monthly savings add up, especially when you automate them. Tackle debt the right way. Prioritize high-interest debt using the avalanche method, paying minimums on low-rate loans, and attacking the highest rate first. If debt feels overwhelming, consider a balance transfer or a debt payoff plan with a clear deadline. Invest early and consistently. Open a low-cost index fund or ETF and automate monthly contributions. The power here is time and discipline. You don't need to pick the next big stock. You need to let the market grow your wealth. Leverage tax-advantaged accounts. If your employer offers a 401k match, contribute at least enough to maximize it. Add a Roth or traditional IRA and use an HSA if you're eligible. These accounts accelerate after-tax wealth over decades. Protect and diversify. Build an emergency fund. Insure against major risks and avoid overexposure to a single asset class. Diversification doesn't guarantee profits, but it lowers the downside while you stay invested long-term. Avoid common traps. Don't chase hot stocks, avoid high-fee products, and guard against lifestyle inflation as your income rises. Stay focused on saving, investing, and compounding above all else. Diversification in practice. You don't need 10 different assets, but you should spread your money across stocks, bonds, and cash equivalents, rebalancing once or twice a year to keep risk in check. Over time, this approach protects you from big swings and helps your long-term plan stay on track. Consider risk tolerance and time horizon. If you are in your 20s or 30s, you can tolerate more stock exposure and ride market cycles. If you're closer to retirement, tilt towards stability and reliable income. Revisit this analysis a couple of times each year to adjust for life events, goals, and changes in the economic environment. Build a weekly wealth routine. Set aside a fixed 20 to 30 minutes each week to review income, savings, investments, and progress toward your milestones. Automations should do most of the heavy lifting, but your weekly check-in keeps you honest and ready to adjust when needed. Here's a practical 90-day action plan. Day 1 through 10. Track every dollar and categorize spending. Day 11 through 30. Finalize a budget and set your savings targets. Day 31 through 60. Automate savings and start building an emergency fund. Day 61 through 90. Secure your first investment and outline a plan for ongoing contributions. Example scenario to make it concrete. Suppose you earned $3,500 a month and spent $2,300. If you save 15% and invest 10% of your income, you'd be putting aside about $525 a month and growing it with market returns over time. Over a decade, that habit compounds into real growth, even without dramatic income jumps. If you found this helpful, like this video, subscribe for more practical wealth-building tips, and drop a comment with which step you'll start today.